This presentation is part one of a four-part series covering advanced accounting. What do you do when you have consolidated financials with a non-controlling interest, i.e. you owe more than 50% but less than 100% of the sub's stock? Non-controlling interest. Although most parent companies do possess 100% ownership of their subs, a significant number establish control with a lesser amount of stock. If the parent doesn't own 100% of the stock, who owns the rest? The shares not held by the majority stockholder are called in the financials of the parent. We call it non-controlling interest, or NCI. The ownership interest of the non-controlling shareholder must be reflected in the consolidated financial statements under the acquisition method. So again, under the acquisition method, when we do consolidated financials, we have to show 100% of the revenue, including the subs, including the expenses, including all of the equipment. And what we are going to do is then have a line item to adjust for the share of profit to the non-controlling interest, and a line item in the equity section as their ownership of the balance sheet accounts. Sometimes in anticipation of a large stock purchase by a corporation, the stock price will go up and then back down after the purchase. This is called the stock premium, and the value is assigned to the parent. Here is an example. Assume big company wants to acquire 90% of little company, 10,000 shares outstanding. Little stock has been trading for around $60 per share. Big has to pay a premium for the shares needed to gain control. If Big pays $70 per share to induce enough stockholders to sell, how will the 10% of little that Big does not own be recorded? So, this is what it's going to look like. We purchased 9,000 shares at $70 a share when the fair market value is $630,000. The remaining 1,000 shares at $60 of little have a fair value of $60,000. This gives total acquisition date fair value of little company of $690,000. What if the fair market value of little's net assets are $600,000? How will the goodwill be allocated? So, it purchases 9,000 shares, which equals $630,000. The non-controlling interest are 1,000 times 60. So we have a total fair value of $690,000. We adjust for the identifiable assets, 90% for the parent and 60% for the sub. And the difference is the goodwill, and in this case, all of the goodwill would be allocated to Big. Now, if the shares were not actively traded, then the consideration transferred by Big would be considered the best measure of fair value of little, and we would estimate the fair value of the non-controlling interest at $70,000. So again, Big shares are 9,000 times 70. Non-controlling interest is 1,000 times 70, giving us a total of $700,000. For our total fair value, we adjust for the undervalued assets, and we allocate the goodwill between the parent and the non-controlling interest. Because the price per share paid by the parent equals the non-controlling interest per share fair value, goodwill is going to be recognized proportionally across the two ownership groups. Non-controlling additional issues. What if bargain purchase? If the total fair value of the acquired firm is less than the collective sum of its identifiable net assets, a bargain purchase occurs. The parent recognizes the entire gain in current income. No gain is ever allocated to the non-controlling interest. Assigning value to the non-controlling interest. GAAP requires the application of the economic unit concept in the acquisition method. A parent is required, what that means is the parent is required to present consolidated net income at 100% for both parents and the subsidiaries' net income, adjusted for excess acquisition date fair value over book value amortizations. Once consolidated net income is determined, it is allocated to the parent and the non-controlling interest on the work papers. Non-controlling interest ownership pertains only to the subsidiary. Its share of consolidated net income is limited to a share of the adjusted subsidiary's income. So remember, it only has to do with the subsidiary's net income. Now let's take a look at an example. Okay, on January 1st, Big purchased 60% of Little's outstanding stock for $36,000. Little's only asset was a machine with a book value of 10, fair market value of 50, 10 years remaining life. They had no liabilities. Any remaining excess was attributed to a trade secret with a 4-year life. Little's total fair market value was $60,000. Now here at the end of the current year, Little's financials are shown. What amount should Big include as part of consolidated net income and back out for non-controlling interest? What is the balance in the investment, Little, for Big and non-controlling interest? And what amount would be included for Little's machine and trade secret on the consolidated financials for Big? Now this is similar to a lot of your homework problems. So we need to know when we bought it. So since we bought it on January 1st, we would include all of the amortization or any income. We only own 60%. We have to remember that. And we know that we paid $36,000. We know the book value versus the fair market value of the machine. And we know it has a 4-year life. And they have total fair market of $60,000. So let's look at amortization. So the consideration at 100% is $60,000. Less the net book value means we have excess over book of $50,000. We know that $40,000 is for the machine, 10-year life, and $10,000 is for a trade secret, 4-year life. So our annual amortization depreciation is going to be $6,500. Non-controlling interest share of net income, Little. Net income of Little is $30,000, less amortization. Adjusted net income of Little, less amount assigned to non-controlling interest would be the $23,500 times 40, which means the amount left for Big in its consolidated financials would be $14,100. What amount of the investment would be assigned to Big and the non-controlling interest at the end of the year? Investment in Little was $36,000. Net income of $18,000 would be added. Our share of the dividends, remember it's times 60%, less our share of the amortization. Our investment account would be $47,100. The non-controlling interest, just take the $47,100 divided by 60% times 40% tells us the non-controlling interest would be $31,400. Now, let's take a look at the amount assigned to Little's machine. Book value of Little, it would be Big's machine for the consolidated financials. The book value of $9,000 plus the $40,000 adjustment to fair market value minus the $4,000 amortization is $45,000. Remember, we show 100% of the subsidiaries adjustment to fair market value minus 100% of the amortization. Amount assigned to the trade secret would be the $10,000 minus the $2,500 would give you $7,500. And that ends this presentation.